Well, there's been a lot of talk lately about silver suddenly waking up because oil caught fire again, the dollar lost a little ground, and the Middle East stopped looking calm for more than about 5 minutes. So in this video, we're going to separate what actually mattered from what merely sounded dramatic, and you are going to walk away with a much clearer sense of why silver moved, why gold moved, why oil still mattered, and why some of the loudest explanations floating around right now are still missing a very important piece of the story. And by the way, today is Friday, April 10th in New York, so tell me in the comments what day and date you're watching from. And very quickly, if you value this kind of content, subscribe and comment John AG Best. That simple support really does help. So, silver had one of those sessions that gets people paying attention very fast. It was not the single hottest performer in the metal space, but it was absolutely one of the leaders, and it finished the day with real energy behind it. Gold was positive too, platinum was even stronger, palladium lagged, but silver, because of how it moved and where it moved, is the one that deserves the closer look. Because this was not just some random green day. This was not just traders waking up and deciding they suddenly loved precious metals again. And in my opinion, this was definitely not a clean, one-factor story either. A lot of people want to make it that simple. They want to say oil went up, silver followed, end of discussion. I don't buy that as the whole explanation. Oil absolutely mattered. It added stress to the macro picture. It added inflation anxiety. It reminded everybody that energy routes can still get ugly in a hurry. But saying oil alone triggered silver is too neat, too tidy, and honestly too shallow for a market this complicated. What really happened was more layered than that. You had geopolitical uncertainty hanging over the whole session. You had a softer dollar earlier in the move giving precious metals room to breathe. You had a market still trying to decide whether this ceasefire story is real, partial, temporary, or just a pause before the next ugly headline. And you had silver doing what silver often does when several currents line up at once. It started trading like an industrial metal, a monetary metal, and a volatility vehicle all at the same time. That is when silver gets very interesting. Now, before we go any further, I want to frame this the right way because that matters. Silver is in a critical zone right now, yes. But critical does not automatically mean breakout. Critical does not automatically mean collapse. It means the next stretch matters more than the last stretch. It means the market is being forced to choose what story it believes. And right now, the market is hearing several stories at once. One story says the crisis is fading. Another story says not so fast. One story says energy pressure cools from here. Another says shipping is still strained and the calm is mostly cosmetic. One story says gold should be the cleaner safe haven winner. Another says silver may have more torque if traders start leaning into a weaker dollar, easier policy, risk off, risk on kind of tape. That is why this move got attention. It wasn't just the gain. It was the message underneath the gain. Now, if you zoom out across the metals complex, the day had a clear shape. Most of the group was positive. Platinum was flying. Gold was steady and constructive. Silver was strong enough to make people think a bigger push might be starting. Palladium was the odd one out. So the tone was not isolated to one small corner of the board. It looked like a broader rotation back toward hard assets, at least for the day. And that matters because isolated silver strength can be dismissed. Broader metal strength is harder to wave away. But here's where I want to push back on some of the excitement. Strong day does not equal clean breakout. Not yet. I still think silver is trading inside a wide, messy range. It can look explosive inside a range. It can feel unstoppable for a session or two and still be doing nothing more than sprinting from one side of the box toward the other. That doesn't make the move fake. It just means context matters. And the context right now is this. The ceasefire theme is still fragile. Based on recent reporting, the truce between Washington and Tehran was already showing signs of strain heading into talks in Pakistan, with accusations over Hormuz commitments and renewed tension around Lebanon clouding the whole picture. There were also reports showing shipping through the strait had collapsed to a tiny fraction of normal after the war started, which tells you the market is not behaving as though everything has suddenly gone back to normal. That is not a stable backdrop. That is a nervous backdrop, and nervous backdrops are exactly the kind that can help silver catch a bid even when the explanation is not obvious at first glance. Then you add oil. Now this part is important because people keep talking about oil as if it moved in one direction all week and therefore explained everything. But the real picture is much more complicated. From recent market updates, the physical side of crude has remained extremely tight even while headline futures have swung around wildly. In other words, the paper market started pricing hope, while the real-world energy system kept pricing disruption. That matters, because silver is sitting right in the middle of that contradiction. One side of the market sees the possibility of peace and starts backing away from the worst-case energy premium. Another side sees bottlenecks, military risk, damaged infrastructure, and delayed normalization, and says the problem is nowhere near solved. Silver responds to both conversations. If oil remains elevated, inflation worries stay alive. If oil eases, but the reason is a truce that also weakens the dollar and pulls rate cut expectations forward, silver can still find support through a different channel. That is why I don't like the lazy explanation that rising oil simply triggered silver. Oil volatility is part of the story, yes, but the deeper story is uncertainty about energy, uncertainty about diplomacy, uncertainty about inflation, and uncertainty about the dollar and the policy path. Those layers matter. Speaking of the dollar, this is another place where people can get sloppy. A weaker dollar tends to help metals because it makes them cheaper for buyers using other currencies, and because it often travels with looser financial conditions or at least looser expectations. But you have to be careful here too. An intraday wobble in the dollar is not the same thing as a major structural trend change. That distinction matters a lot because the broader dollar measures coming from the Fed's trade-weighted data still show a dollar that has been relatively firm into early April, even if the more familiar day-to-day dollar chatter has recently felt softer. So yes, silver got some help from dollar weakness in the moment. But no, I would not build my entire thesis on the idea that the dollar has suddenly rolled over for good. It may have. It may not have. The point is that part is still developing. And silver right now is trading off development, not certainty. Now let's bring in another layer, because today was not just about geopolitics. It was also about policy expectations. The latest U.S. labor numbers showed payroll growth improving in March while the unemployment rate held roughly steady in the low fours. That does not describe an economy falling apart. But it also does not describe an economy that is racing so hard the Fed can relax about inflation either. Then you had the consumer inflation release on the calendar this morning in New York. That is a big deal. Because whenever CPI lands on a day like this, traders start leaning forward before the number even hits. They start guessing whether energy pressure is about to show up more clearly, whether core inflation remains sticky, whether the Fed needs to stay cautious, or whether weaker growth and softer demand will eventually win the argument. Silver likes that kind of confusion. If inflation looks sticky because energy is hot, metals get hedge demand. If growth looks more vulnerable and traders start thinking about easier policy later on, metals get support again. And if both of those conversations are happening at the same time, silver can suddenly start outperforming gold for brief windows because it has more emotion, more torque, and more tendency to overshoot. That is exactly what this session felt like. Not calm accumulation, not sleepy value buying, velocity. Now, I also want to talk about technical analysis for a minute, because on days like this, you always see charts getting passed around like they are final truth. Some of them are useful. Some of them are just noise wearing a blazer. And silver is one of those markets where people can become way too attached to a clean pattern, while the market itself is behaving in a very messy way. I'm not against charts. I use them. I respect them. But when the chart narrative stops matching the actual behavior in front of you, you have to stop pretending the model is in charge. Price is in charge. Always. So if silver is pressing higher, holding important shelves, and refusing to follow the clean bearish script people were expecting, then the responsible response is not to force the chart to confirm your opinion. The responsible response is to admit the market may still be trapped inside a range, maybe squeezing, maybe frustrating both sides, maybe waiting for a catalyst that has not fully arrived yet. That happens a lot, and on silver it happens even more. So what levels matter? I'm less interested in ultra-precise numbers than some people are, because silver loves to run stops and then reverse. But broadly speaking, the low 70s still look important as a first layer where buyers have shown up before. Beneath that, the upper 60s still matter as a deeper support zone if this move loses steam. On the upside, the mid to upper 70s remain the area where silver has to prove it can do more than just spike and fade. That is the battlefield. That is worth remembering here. And yes, it is a wide battlefield. But silver has earned that kind of wide range lately. There is also the volatility piece, and I do not think enough people are talking about that clearly. The exchange itself highlights an implied volatility gauge for silver options, which tells you the market is actively pricing meaningful short-term uncertainty into silver futures. That should not surprise anybody. Silver is one of those assets that can spend days looking completely manageable and then suddenly start moving like everyone forgot where the brakes are. When you combine a headline-sensitive macro backdrop with an asset that already has a reputation for exaggerated responses, you get exactly the kind of tape we are watching right now. And that matters for interpretation. Because when volatility is elevated, a strong session can be both real and unreliable at the same time. Real, because buyers clearly stepped in. Unreliable, because follow-through becomes harder to predict when the market is being pushed around by diplomacy, shipping risk, inflation expectations, and rate speculation all at once. That is why I keep coming back to the close. If silver can string together strong closes, that is one thing. If silver just keeps producing dramatic intraday candles and then fading, that is something very different. Now let me say something about platinum and palladium too, because the relative move across the metals board tells you a little bit about the mood underneath this session. When platinum is leading and palladium is lagging while silver also stays strong, the market is not acting like it is hiding in one pure fear trade. It is acting more like it is repricing a broader metals basket under a mix of macro stress and selective optimism. In other words, there is fear in the tape, yes, but there is also rotation, speculation, and relative value positioning. That is another reason I would be careful with simple explanations. And silver, more than almost any major metal, thrives in blended trades because it gives both camps something to latch onto. Safe haven people can point to geopolitics and the dollar. Growth-sensitive traders can point to industrial demand and risk appetite. Inflation worriers can point to oil and policy uncertainty. And momentum traders do not need any of those arguments to be perfect. They just need the move to keep moving. Sometimes that blend is obvious right away. Sometimes it takes a few sessions to reveal itself clearly. The hard part is figuring out which one you are seeing before the next catalyst hits. There is another fresh detail from the silver outlook that I think is worth slowing down for. Even though industrial fabrication is expected to cool somewhat this year, the forecast still points to a market that is drawing on above-ground stocks to fill the gap. That is not the kind of background you would normally describe as loose. It is a market where the physical side remains tighter than casual observers may realize, even if the demand composition is shifting underneath the surface. That nuance matters, because a market can have softer demand in one important category and still stay fundamentally tight if investment flows recover, if recycling does not fully close the gap, and if inventories are already doing too much of the work. That is part of the reason silver keeps resisting the easy bearish argument. The fundamentals are not screaming in one direction, but they are not exactly comfortable either. And when fundamentals are uncomfortable at the same time the macro backdrop is uncomfortable, price can become much more sensitive to changes in sentiment. That is what we are dealing with. Not a clean boom, not a clean bust. Sensitivity. And sensitivity is usually where the biggest surprises are born. Now, here is another piece I think a lot of people miss. Silver is not being driven by one identity right now. According to recently published industry numbers, the global silver market is still expected to run another annual deficit, which would make it 6 straight years of demand outpacing fresh supply. At the same time, total supply is expected to climb to a multi-year high, and physical investment is expected to rebound strongly. Industrial fabrication is projected to soften somewhat, especially because solar manufacturers keep finding ways to use less silver per unit. But that softness is not the whole story. Data centers, artificial intelligence build-out, and parts of the auto sector are still expected to support consumption. That is a very big deal, because it means the old, lazy silver narrative is no longer enough. You can't just say silver is a precious metal and stop there. You can't just say silver is an industrial metal and stop there. It is both, and the balance between those identities can swing fast. If fear rises, silver leans toward gold. If growth optimism rises, silver leans toward copper. If both happen together, silver becomes something else entirely. That something else is what traders are trying to price right now. And that is why the move feels stronger than a normal bounce. Now let's come back to gold for a second, because silver was not moving alone. Gold has been trying to hold itself together through a strange environment. Recent market coverage showed gold still on track for another weekly advance, even though it remained well below the panic highs from earlier in the conflict. Why? Because investors have been balancing ceasefire uncertainty against a possible easier rate path, and that combination has kept gold firm even when it has not looked explosive. So gold is constructive, not euphoric, constructive, and silver is following that lead, but with more emotion. That is normal. Silver usually needs a gold story to lean on, but once it gets one, it can exaggerate the move in either direction. That seems to be what we saw here. Gold provided the anchor, silver provided the drama, and the gold-silver relationship is telling you something too. When silver starts narrowing that ratio during a tense macro backdrop, it often means the market is becoming a little more willing to express risk through silver instead of hiding only in gold. That does not mean the all-clear has been sounded. It means confidence, or at least speculative appetite, is creeping back around the edges. That is a subtle change. But subtle changes matter before bigger ones do. Now, let's talk more directly about the peace talks, because this is where the next move probably gets shaped. According to the latest public reporting, authorities in Pakistan were preparing for the first round of direct U.S.-Iran talks over the weekend, and the sticking points still include shipping through Hormuz, and whether the ceasefire should cover Lebanon as well. That matters because if one side thinks Lebanon is covered and the other side says absolutely not, then you do not really have clarity. You have competing versions of the same agreement. And markets hate competing versions. They can trade around bad news, they can trade around good news. What they struggle with is ambiguity. Ambiguity is where volatility breeds. So going into those talks, here's how I'm thinking about it. If the talks produce even a modest sign that shipping will normalize, that cross-border strikes will ease, and that both sides want to stretch the truce rather than simply survive it, then oil could calm down further, and gold may lose some emergency premium. In that case, silver's reaction gets more interesting, not less interesting. Because then the question becomes whether silver can stay buoyant, even as pure fear eases, maybe on the back of dollar softness, policy hopes, and renewed interest in cyclical metals. That would be bullish in a different way. But if the talks disappoint, if the Lebanon issue blows up the process, if shipping stays squeezed, if more attacks hit the tape, then oil can remain jumpy, inflation fear can stay alive, and precious metals can keep finding support through that route too. See the problem? Silver has more than one path higher. That is why people are watching it. But it also has more than one way to get chopped up. That is why you have to stay humble. This is also where I think a skeptical alternative interpretation is healthy. A lot of people are acting as though silver going up during this crisis proves the market has settled on a durable inflation hedge narrative. I'm not sure we can say that yet. Another interpretation is that traders are simply reacting to a very unstable headline cycle, covering shorts, leaning into momentum, and using silver because it moves faster than gold. If that is the case, then some of today's strength could be tactical rather than foundational. That does not mean bearish. It means do not confuse a fast market with a finished argument. There is a difference, and silver punishes people who forget that. Now, let's widen the lens again, because the cross-asset backdrop adds another clue. Recent reporting showed that global stocks were mixed as investors tried to decide whether the worst-case scenario had been taken off the table or merely delayed. European shares were softer. Parts of Asia pulled back after huge relief rallies. Wall Street was positive, but not wildly so. Treasury yields sent a mixed message. The dollar slipped. Oil rallied hard intraday, and then gave back a chunk of it by the close. That is not a market at peace. That is a market trying to price hope without fully believing it. Silver thrives in that kind of half-belief, because it can borrow some of the safe haven bid without losing the cyclical argument entirely. That is a powerful combination when it works, and frustrating when it doesn't. There is another fresh angle here too. The energy outlook from official U.S. sources still assumes a meaningful risk premium in crude because of ongoing uncertainty around Middle East disruptions, with the price path expected to stay above pre-conflict levels for a while, even if conditions eventually improve later in the year. That matters because silver does not need oil to explode forever to benefit. It simply needs the market to believe energy risk has not fully gone away. That belief is still very much alive, and as long as that belief is alive, the inflation conversation remains alive too. Now, I know some people hear all of this and say, okay, then why not just buy gold and forget silver? That is a fair question. Gold is cleaner, gold is steadier, gold usually carries less drama, but silver has something gold does not have in the same way, and that is acceleration. When silver catches the right blend of macro pressure, industrial hope, investment demand, and short covering, it can move with a speed that gold rarely matches. That is the attraction. That is also the danger. Because if one of those pillars weakens at the wrong time, silver can reverse just as quickly. That is why a strong close matters more than a flashy spike. Silver loves to seduce people with the high of the day. What matters more is where it settles. If it keeps closing strong, that tells you buyers are not just chasing, they are defending. If it keeps making dramatic highs and then giving them back, that tells you the move is still more emotional than durable. That is what I will be watching, and I would strongly suggest you watch the same thing. If you're successful, share your success story in the comments so others can stay motivated. Now let me put the whole picture together. Silver finished strong because uncertainty is still doing real work in this market. The dollar gave metals some breathing room. Gold stayed constructive enough to provide an anchor. Oil reminded everyone that inflation risk has not vanished. Pakistan-hosted talks gave traders a near-term event to focus on, and the broader silver story remains quietly supportive because the market is still expected to run a deficit this year, with investment demand improving even while some industrial categories cool. That combination is powerful, but it is not simple, and I think the people who reduce it to one clean headline are actually doing you a disservice, because that kind of explanation sounds confident while hiding the real risk, which is that silver can reverse violently if any one of these pillars softens at the wrong moment. So what should you watch next? First, watch the talks. Not the hype around the talks, the actual outcome. Second, Watch whether shipping through Hormuz starts to normalize in a way the market can trust, not just in a way politicians can talk about. Third, watch the dollar reaction to incoming U.S. inflation data and shifting policy expectations. Fourth, watch whether gold can stay constructive even if emergency fear cools a little. And fifth, watch whether silver can keep closing strong instead of merely printing flashy intraday highs before fading. That last part matters a lot, because silver loves to make people feel smart for about 3 hours and then very confused by the close. Now, I also want to say something about excitement, because I know a lot of people want silver to go vertical immediately. I get it. I really do. When silver starts moving, it feels like something big is finally happening. But the healthiest bullish case is not the one where markets break, prices detach from reality, and nobody can trust a quote. The healthiest bullish case is the one where silver gets repriced in a functioning market because supply stays tight, investment demand improves, and macro pressure keeps feeding the bid. That is the better outcome. That is the more durable outcome. And frankly, that is the outcome you should want if you care about being able to act rationally when the opportunity shows up. Because if the whole system goes chaotic, everybody imagines instant wealth. Reality usually looks more like wider spreads, worse liquidity, more regulation, more confusion, and fewer good decisions. So I am not rooting for chaos. I am rooting for clarity, even if clarity takes a little longer. And I think that is the right way to approach this setup too. Be interested, not euphoric. Be open-minded, not gullible. Be willing to change your view if the facts change, but do not let one dramatic session force you into a permanent conclusion. Silver has earned respect. It has not earned blind certainty. Now, one last thing before I close. The fresh macro backdrop around silver is more nuanced than many people realize. Payrolls improved in March. Unemployment stayed pretty steady. CPI arrived on the calendar at the end of the week. Oil remained sensitive to every Middle East headline. The physical crude market kept signaling more strain than the futures market wanted to admit. And the silver market itself is still expected to be short of supply on a global basis for another year. That is not a trivial mix. That is exactly the kind of environment where silver can keep getting yanked between breakout hopes and range trading reality. So yes, today mattered. Yes, the move was real. Yes, the strength versus gold mattered. Yes, oil mattered. Yes, the ceasefire story mattered. But no, I do not think one simple sentence explains all of it. And honestly, that is the biggest takeaway. When silver starts moving in a world like this, it is usually because several forces are aligning just enough to create pressure. Not because one headline magically flips a switch. The people who understand that tend to stay calmer. The people who do not usually end up chasing candles, panicking on dips, and wondering why silver feels impossible to own. It feels impossible to own because it is a complex market pretending to be a simple one. Do not let it fool you. If this market keeps developing the way it looks right now, the next few sessions could tell us whether silver is merely stretching inside the same broad box or preparing to make a more serious attempt at leaving that box behind. And those are very different setups, even if they can look identical for a day or two. So keep your eye on the reactions, not just the headlines. Keep your eye on the close, not just the spike. Keep your eye on what the market does after good news and after bad news. That is where the truth usually shows up. Thank you for spending part of your day with me. Subscribe if you haven't already. Keep the comments coming. And stay close, because the next round of headlines out of the energy market and those talks could matter a lot more than people think. And as always, take this for what it is, an educational market discussion built to help you think more clearly, not personal financial advice tailored to your situation. Your money deserves your own homework, your own risk limits, and your own decisions.